Good morning and welcome to this Wednesday, June 17th edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're looking at futures that aren't too bad again today. Market looks like it wants to continue its recent move to the upside, which I think is a good thing. Currently, the Dow Jones Futures are up about 115 points. They are down a little bit from where they were earlier this morning, but up is up. S&P and NASDAQ both up as well. We did see overnight, Asia was a little mixed, mostly higher, but mixed. And then this morning in Europe, we like to keep an eye on what goes on with the German DAX, because the S&P 500 has its strongest correlation. If we look at all the global indices, the S&P 500 and the German DAX probably have about the strongest positive correlation. The DAX this morning is up about 102 points, or about 0.83%. So things are looking up this morning. We're going to get into what happened yesterday in just a moment. But first, I do want to just remind everyone. Actually, I can't share my screen here, Chris. So, okay, let's try that. There we go. So if you look at earningsbeats.com, if you're not a member, if you're not familiar with Earnings Beats, you can go in and subscribe. We have a free newsletter. No credit card required, just your name, email address. Click that subscribe button. You can unsubscribe at any time. But it does come out Monday, Wednesday, Friday. Had an article this morning I wrote. And usually it's just featuring one stock or one industry group. Just gives you something to think about. Usually it has an educational slant to it. But sign up for that if you haven't already. Again, it is completely free. No credit card required. Name and email is all that you need. Looking at the action yesterday, we did see the Dow Jones Industrial Average finish up 2%, up 526 points. There was some volatility, but we did close near the highs of the day. The S&P 500 up nearly 2% as well. The NASDAQ 1.75%. Mid caps and small caps both over 2%. Small caps actually 2.5%. So we saw some relative strength there. The sectors, we had all 11 sectors higher, but we were led by energy, which was up almost 3%. Healthcare hasn't been up near the top recently. Healthcare has been struggling on a relative basis. I mean, if you look at these charts, you can see all of them pretty much have an upward slant, except healthcare, where we actually look like we might be having a breakdown just a couple of days ago. But we rebounded really nicely from that, got back up almost to that 20-day moving average on the close yesterday, looking to break out there. But really, the healthcare group, the XLV, what we want to see is a breakout above about 104.50 to 105. I think that would confirm the next breakout. And I think we'd start to see a lot better relative performance once we got an absolute breakout. Part of the problem with healthcare, if you look at the slope of this move up off of the bottom back in March and April, it was stronger than anything else on the chart. Literally, it was healthcare and technology that was leading us out of the March doldrums down at the lows. And since then, healthcare simply has just been going sideways and consolidating. Not really bearish. Again, earlier this week and the latter part of last week definitely looked like we were threatening a breakdown, but we came right back up off of that. And so I'm looking at this as consolidation, which isn't a bad thing. It's just unfortunately leading to a lot of short-term relative weakness. But I do expect a breakout and then some relative strength resuming there. We'll see. Technology has been a consistent leader off of that bottom, and even before that, even throughout the lows, on a relative basis, technology has been doing very well. Discretionary up nicely yesterday. Got a big lift from the retail sales report for May. That was the best monthly retail sales report in history. Now, it came off of some pretty rough reports prior to that, so you got to take all that into account. But still, if you're looking for a V bottom, you want to see retail sales bouncing and rebounding like that. And that retail sales report yesterday, I think the gain was 17.7%, which is just astounding. But again, it's coming off the depths of what we saw with the virus. Materials also strong day. So all five of these groups, you can see over 2%. And as I mentioned at the top, all 11 sectors did manage to finish in positive territory today. So that was, or yesterday, so that was very good. All right, let's see. What else do we have going on? How about the 10-year Treasury yield? From an economic standpoint, we had May housing starts and building permits out this morning. The good news is May was better than April, was quite a bit better than April, actually. In terms of housing starts, we came in at 974,000 units. April was only 891,000. That's the good news. The bad news is the market was actually expecting 1.1 million units. So May housing starts came up well short of expectations. Building permits, barely short of expectations, but very similar. Easily beat the April number, which was 1,074,000 units. We came in with May building permits of 1,220,000 units, but Wall Street was expecting 1,250,000. So we came in 30,000 short. So not great numbers in the housing group today. I'm going to talk a little bit more today about home construction as I go through today's show. And it'll be interesting to see how the market reacts to that, because we've been getting some pretty good news out of the housing market, at least better than expected. And with the Fed coming out recently and saying interest rates going to stay down near zero for a couple more years at a minimum, that I think is a backdrop that home construction can thrive in. If the market begins to pick back up, if our economy strengthens, incomes rise, jobs are created, and then you've got interest rates remaining near zero, that could be nirvana for home construction. So seeing how this group rebounds, or how it reacts to the disappointing housing starts and building permits this morning, will be one thing to watch in today's action. All right, I'm going to now go into, you can see the 10-year Treasury yield, by the way, relatively unchanged today. We are down now about 1 basis point, 0.75%. I think, established a near-term top that is up around the 0.95% area. To the bottom, I think now we've got a few different lows down around 0.65, so I think we're in this range. I'm not going to be too worried one way or the other as long as we stay in this range, but if we break back down to the downside, that could be a problem for the market, because that'll be indicating that money is rotating back into treasuries, being more defensive. And when the bond market is being defensive, typically that either means sideways consolidation for equities or a drop. Rarely do you see the 10-year Treasury yield falling and breaking down and equities going straight up. Not too often. One exception to that was when we had the Fed, backing the market back in 2012 to 14 with all the QE. So we had the Fed buying Treasury, sending the yield down, but that also was helping support the market. So we saw both bonds and stocks being bought at the same time. But that is unusual. So watch this. This is one clue I always watch every single day. It's why I mention it during every show. I like to know what's going on in the bond market. All right, let's move on. Talking technically. Today I want to go over just the S&P 500. Just take a look at what's been going on. Because obviously we had an all-time high up near 3,400. We had the depths of the pandemic down at 2,200. And since then, we have been rebounding very nicely. I am of the opinion that this is going to be a one-and-done deal on the pandemic. I think, we got some brilliant scientists all over the globe working on this. I think we're going to get past this. Unfortunately, it's an awful thing from a health perspective and from a jobs perspective, business perspective. But I do think that it's going to be short-lived. And I think that's what stock market is telling us. Stock market's really smart. Not quite as smart as the bond market, but it's really smart. And so as a leading economic indicator, and I think it's probably the best leading economic indicator, it's the one I rely on the most. When I see the market doing this, coming back up off these lows, I think what it's telling me is the worst is behind us. Yes, we may have a second wave, but I think what we priced in back in late February and throughout the first 3 weeks of March, I think we priced in almost the Great Depression. Not quite. Obviously the Great Depression we had back in the late 1920s and throughout the 1930s, we saw a tremendous drop, probably 90% or more on the major indices. So this was about 33%. So maybe I shouldn't say it priced in the Great Depression. But when you talk about losing 33%, 35% of the market value of all S&P 500 companies over the course of about 4 weeks, that's pretty crazy, and it hasn't happened very often in our lifetime. So, there was a period in 2008 during the financial crisis, another period back in 1987. And outside of that, we haven't seen anything that in my lifetime that rivals what we saw in February and March. So the market was pricing in a lot of really, really bad things. And it's been bad. But I think the market is telling us it's not as bad as we thought. We're coming back out of it. Retail sales jumping 17.7%. I mean, you can't ignore these things. And so I think we're back in an uptrend. Now, are we going to go straight up past 3,400? That remains to be seen. It wouldn't shock me because the interest rates now are lower than they were back in February. And if you're looking at valuations, if you've got a company like Apple that can keep growing its earnings and you've got interest rates even lower, those earnings are worth more. Apple should be valued higher than it was back in February. So when you've got some of the top market cap, or cap weighted companies in the S&P 500 that are growing their earnings in a very low interest rate environment, you're going to see this kind of reaction back to the upside. The problem is some of the other companies in the S&P 500, your airlines and cruise lines and so forth, they're going to be a long time getting those earnings back up to where they were in February. And so it's the net effect. Apple, Microsoft, Amazon, all these companies are screaming up to the upside. Tesla, with their profits in a low interest rate environment. And then you've got airlines and other areas, gambling stocks, hotels, the cruise lines, recreational services, those types of areas are holding back the S&P 500. So it's a net. So the net right now, we're moving up. But I think some of those, the Apples and Amazons of the world are going to continue to grow their earnings. And I think that's what's going to continue to lift the S&P. And some might argue, well, it's just, a handful. Well, that's the way the market works. I mean, I think there's going to be more than a handful. I think people get a little carried away and a little bit too much drama there. But there's a lot of groups going up. It's not just Apple, Microsoft, and Amazon and Tesla. There's a lot of groups, if you look, that are outperforming the S&P 500. Toys are doing incredibly well right now. Certainly some of the other broadline retailers, some of the other areas of retail are doing well. So there's a lot going on. I mean, we've got software, obviously, computer hardware, semiconductors. There's a lot of areas that continue to grow their earnings, even through this pandemic. And that's what's lifting the market. So anyway, when I look at the S&P 500, I feel like in the short term, we established a little top there over 3,200. The big gap down and sell-off that we saw last Thursday came on pretty good volume, but so far that level is holding. So I'm going to annotate this chart, just kind of show you a couple things on the daily chart that I would be watching. I'm looking at this area right in here. I mean, I don't want to draw two lines because they're really, well, I guess I could draw two lines and just make them a little thinner. There's a couple areas in the short term to the downside that I'd be watching, and these are the two levels. Now, if you look here, this is where we gapped down from when the March selling really kicked in. This first move was that first wave, but we didn't take out these prior lows. I kind of look at this move right here as being really important. And when you notice, when we came back up, look, we failed here, we failed here, we failed right in here, all of these right at this gap resistance area. And then in late May, when all the rest of the stocks, besides the pandemic, the pandemic winners like Zoom, Peloton, and some of those type stocks, the rest of the stocks, airlines, recreational services, it was in about mid-May. That's when those groups started moving. And that's what created this breakout above this area. So on the downside, I'm looking at this as being the first area of support. I would be surprised if the S&P goes down here and closes below these levels and that 50-day moving average, because I think we're in an uptrend. And I think we could consolidate, we could get a 50-day test, but I don't think we're going to go below. So this is an area, I'm thinking if the S&P were to go back down below 2,900, I'd want to reevaluate. Not that I'd be thinking we're going to 2,200, but I think it would start to bring some of these other support levels into play that we'd have to watch. So for right now, I'm thinking 2,900, 2,900 to 2,925, kind of that area I would say is probably my short-term worst case. And if that breaks, then we need to talk a little bit more about maybe summer consolidation and maybe even a little bit more of a dip to the downside, which wouldn't be horrible. I mean, considering where we were, we move up and we did pull back into the 2,800 range over the summer. That wouldn't be a horrible thing. In fact, I think it would set up beautifully for the fall, but we'll take it one day at a time. So watch that level to the downside. To the upside, there's your recent high. And here's another key area of gap resistance that hasn't been tested yet. So we got up close to it, rolled over. So I think this is kind of our range in the near term. As we get closer to the top, I'd maybe be a little bit more cautious. We get closer to the bottom, I'd probably be a little bit more aggressive. All right, let's move on to home construction. Talked about home construction. First thing I want to do is just show you this relative strength chart, home construction versus the S&P 500. We have our relative strength industry group chart list that has every industry group on it. And so when I see an area, you know, an industry group that I like, it's pretty easy. I can just come right in here and pull it up. And anybody who's an annual member of Earnings Beats, we send this chart list to you if you're also an extra member at Stock Charts or above. You've got to be at least an extra member to be able to download chart list from another member. So if you're already an extra member over at Stock Charts and you're an annual member at Earnings Beats and you're not getting this or you haven't gotten this, write to us. We'll explain how you can do it, but you can just go into our chart list page and it says under the industry group relative strength chart list to contact us. And we'll send you the link and the password. But anyway, take a look at what's going on here with home construction. This move off of that March low, straight up for the most part. We have been seeing tremendous relative strength. This is one of the groups that got beaten down the most because, again, the market was pricing in my opinion, the worst case scenario. The worst case scenario is everybody was going to lose their job. Nobody was going to buy a home. And so home construction really got hit. But when we started coming out of it, I think the market started saying, hey, this isn't quite so bad. I think also everyone started to realize interest rates are going to stay low for a long time. The Fed just came out and confirmed it. Look at what's going on here recently with the relative strength in this group. After the Fed came out and said, hey, we're going to have rates remaining near zero for more than 2 years. Enjoy. Home construction, one of the biggest beneficiaries, going straight up. So this is a group I think that's really strong. So how would I dig into the home construction group? Well, the first thing I would do is go to the strong earnings chart list and see which of those companies have been performing the best. So what you can do is if you type in home construction in the search box, so here's our strong earnings chart list. This is another chart list that any member at Earnings Beats can have. We can download. You can be a trial member and you can download this list. And trust me, there are a lot of companies on here. These are all companies that beat Wall Street's estimates as to both revenue and earnings in their last report, and also I thought looked pretty good on their charts. So they either were showing good absolute strength, good relative strength, or maybe they were part of a really strong industry group. But this is a great list to trade off of. This is really our flagship chart list over at Earnings Beats. So anyway, once you get in here, though, I mean, I've got it sorted by scooter. But if I like home construction, I just type in home construction. And once I get to this point, there they are. Those are two that are on our strong earnings chart list right now. These are both small cap home builders. But if you pull up their charts, you can see obviously in a very strong uptrend, nice rebound right off the 20-day moving average. If there's one problem for me, at least in the near term, I think actually this one, I would not be jumping into this group. We've come up a lot. Number one, you've got the higher highs, you got the lower PPO. So I got a negative divergence here. Maybe with this weak housing report today that we saw, the housing starts and building permits coming below expectations, this group might be under pressure today. And so looking at the chart, this is one that I'd be a little concerned about. The other one was MHO. Very similar looking chart, bouncing off the 20. But as we keep trying to go higher, look at that daily PPO rolling over. I'd be a little careful with this group for sure. Also, as it's trying to make these breakouts, I don't know, I'd like to see a little bit more volume coming in. Volume wasn't bad yesterday, but you can see we failed on that breakout. So both of these look a little suspicious to me in the near term. When I see negative divergences, I could see as far as a 50-day test, as far as a centerline test on the PPO. So these are a couple stocks, I think, in a group that could struggle here over the near term. I'm going to say maybe a week or two. I'd be a little careful right now with home construction. Again, with that report coming in below expectations, that's another reason to be a little fearful there. All right, but that's how you can use this strong earnings chart list. I mean, you could go in here and say, okay, what about semiconductors? You know, if you like semiconductors. Well, there you have it. There's the list of semiconductors in scooter order, telling you the best relative strength charts. And then also, these again are companies that have beaten Wall Street estimates. As a former practicing CPA, this is really important to me. I like to combine both fundamentals and technicals. You got a lot of folks out there that are fundamentalists, a lot of folks out there that are technical analysts. Well, I like to pride ourselves at earnings beats. We're both. So we like to combine the companies that are producing really strong fundamental results, and then also look good technically. And I think our members really enjoy having this list basically handed to them. I update it continually. As soon as I update it, members can go into our website and download it right into their account. You click on a link, enter a password, boom, it's in your account, literally 5 seconds. But yeah, semiconductors, so that's another group. If you liked it, you just go in, just type whatever. You can see DXCM, medical supplies. So if you liked medical supplies, there you go. Here's the group that's in here, medical supplies, scooter order. So you can see EW is kind of weakened. BAX, that one has, well, it's down at 50. Cardinal Health, 71. Merit Medical, 86. You can kind of get the whole list here. So that's another way to, to take an area of the market and then drill down to try to find individual stocks within that. I remember when I was writing blogs over at Stock Charts several years ago, I would get a lot of emails and folks would say, I hear you talk about industry groups a lot, but what do you do with that? I mean, if you have a breakout in an industry group or you have a pullback to a key support level in an industry group, I can't trade the industry group. What do I do? Well, these chart lists and this search box, boom, literally I can go to my strong earnings chart list, type in the industry group, and I've got 8 medical supply companies right here I know that have beaten earnings, and I know they've beaten revenues. They're pretty sound, and I can, based on the tools that I have here at Stock Charts, to be able to quickly sort them in scooter order. It tells me right at the top, these are the ones I want to look at first. I mean, I think it's a great way to be organized, to do your homework, and to be ready every single day in the market. All right, one other thing I want to tell you about, if you like, say, home builders or whatever, you can go into scooter reports. This is another way to access. So if you go into the scooter reports, it's based on large cap and it's in scooter order. Again, type in home construction. And there you go. These are the large cap stocks in scooter order. You don't want large cap. You're looking for mid cap. Change it. Mid cap. There's 2 in mid cap. And here's your small cap. So again, there are different ways to quickly zero in once you know an industry group. All right, let's move on to earnings spotlight. Just a couple earnings out last night, not really much this morning. Oracle came in, they did beat on their bottom line. I think $1.20 versus $1.14. Stock is down though. It hasn't been able to make this breakout, and I think it's down, I was showing down 3.25% last time I looked this morning. So it's probably down about $1.50 or so, or maybe a little more than that. So it's maybe in the 52.75 range, something like that. So it's in the middle of this sideways consolidation. I don't think it's telling us anything yet. Now with earnings, maybe it breaks out later today, maybe it breaks down. So I'd be watching it, but I wouldn't be doing anything at the open. HRB, this is the H&R Block. H&R Block uptrending, you can see, looking pretty decent. They matched estimates, $3.01. That's exactly what Wall Street was looking for. They're up 1.5%, but that's not much. And similar to Oracle, I think you've established your high and your low. You're trading in the middle of it. This is a little bit more of an uptrend, but it's still quite a bit off of the highs that it saw back in February, still down about 25% or so. This isn't going to be one of my favorite stocks. And if you look on a relative basis, you can see relative to its peers, it's been going down. Relative to the S&P, for the most part, it's been going down, even though Recently, we got a slight move to the upside. I don't know. I'm still going to be a little careful here. I'm not interested in HRB. Last one, Groupon. They came out. They had a really big beat. They still lost a ton of money, though. They lost $1.63, but the market was looking for a loss of 201. So they came in much better than expected. The stock's been rising the last couple of days. That's a pretty good move from 20 to 27 and change. It is up another 6% today. So it's probably up in that 28.50, 28.75 area. Still got some work to do. I would make sure 20 holds. I think now we've gone down, tested that level twice. If we fail, this could be a right shoulder. So if we go back down and fail, that would be a left shoulder, neckline, head, right side of the neckline, right shoulder, and a breakdown below 20 would be very, very bearish. So 20 is my line in the sand. Of course, that's quite a ways to the downside from 27 and change, but I just wanted to mention that pattern. We're going back up. Volume's been good. We're up against this gap resistance, but it looks like we're going to open up strong. What I don't want to see is a lot of selling after that gap up. So we'll watch Groupon throughout the day. All right, upgrades and downgrades. Let's look at, no, it's not the one I want to look at. Oh, I probably didn't put it up there. Okay, let's see. First, oh, here it is over here. Got it in bad, wrong order. All right, so upgrades and downgrades. First of all, Raymond James was out this morning upgrading and downgrading a lot of financial companies. And so most, I don't know, 3 or 4 of these will be Raymond James financial companies that they looked at. But CADE, they upgraded. Stock's up 5%. When I look at it and I look at it relative to the banks, it's starting to show relative strength for the last couple months. But overall, when it does show a little bit of relative strength here, goes back down, starts to strengthen, goes back down. It's got a history of doing that. I think there are many other banks look better to me. So stock is up almost 5% in pre-market, but I think there are other banks that I like better. EBSB also upgraded. Once again, look at the relative strength versus banks. I don't like these upgrades. Stock's not, Wall Street doesn't like this firm or this bank, and so I'm not going to like it until I start to see better relative strength. It is up 5.4% in pre-market. We'll see what happens there. The one that they upgraded I did like a little bit better is SIVB. Do you see the relative strength here versus banks? So this is one that's actually been performing better than the bank index. If I have any hope of beating the S&P 500, I need a bank that's at least beating its index, because the index has been horrible relative to the S&P. So I think this is one that I could get behind, although I'm kind of on the fence with banks. I think that the economy is going to strengthen. I think interest rates will go up a little bit, the yield. And I think as things begin to look a little better, then some of these banks that have increased their loan loss reserves so much over the past couple of months, I think they might start to, prune it a little bit, trim it down, and that could give banks better earnings than expected going forward. So, I'm thinking the banks are probably not a bad value play, but I want to see a little bit more relative strength in the overall group. See how it's really struggled over the last few months to break out. If it breaks out, then I'm going to start to look at banks a little bit more significantly. But anyway, SIVB I thought looked pretty good. Downgrades, this one I didn't understand at all. Raymond James downgrades Commerce Bank shares. This one I think overall has been showing pretty strong relative strength. I like this better than the ones they upgraded, to be honest. And then there were a couple of downgrades that were outside of banking, and also I think they were different firms as well. It was not Raymond James, I don't believe. The first one is KLA Corp. This has been one of the stronger semis. It's in one of our portfolios. I really like the stock. Been trying to break out. Got that double top in play, though. Maybe it comes back down for another 20-day test. But overall, I like the stock. The other downgrade was Valero. And Valero, when you look at this one on a relative basis, its group has been strengthening, and the stock relative to the S&P has been strengthening. And I think overall, relative to its peers, it's been doing pretty well, except for the last few weeks. And I think that's just simply because we had a pullback in an uptrend. I don't really see anything horrible here. Again, if you go down and you close below 60, might be a different story, but I actually think this one could be okay. All right, 3 you must see. What I did for the 3 you must see is if you go into the, no, that's not, which one was it? Well, let's go back. Here it is. S&P 500 components. What I did, S&P's been pretty strong over the last few weeks. So I thought what I would do is look at the worst performing S&P 500 stocks over the last, 1 week, and pick whatever's been the worst performers the last 3 weeks. Look at the scooters, 2, 1, and 6. So obviously these are challenged stocks, but I did notice the first one, clothing accessory stock, PVH Corp. That's a group that really benefited from the retail sales. So I was surprised to see a clothing accessory stock here near the bottom or at the bottom, but this is the one at the bottom. So let's start off with PVH, and then we'll take a look at NOV and ALK, and we'll wrap the show up. So PVH has pulled back. We had multiple days in a row of moving lower highs. And then yesterday we actually started an uptrend potentially. So I think as long as I would maybe watch the low from yesterday and hope, look for that to hold. But if it does, I think we have a chance to run here a little bit on PVH back to the upside. So I'm okay. Now, this is not a great relative performer, and the group itself is starting to strengthen. But PVH, I think they just came out with earnings and went down after earnings. I think we could see movement back to the upside. I don't think this is the best clothing accessory stock out there to trade right now by a long shot. But I do think that this is a stock that could rebound a little bit further from here. Next up is NOV, which is National Oil Well Varco. And this one, bothers me a little. Look at the relative weakness. This has been really poor versus its peer group. Its peer group showing a little bit of strength versus the S&P, but the stock is not doing well versus its peer group. And for the most part, saw a lot of selling back in here. I don't know, they showed a little volume pickup here as we moved up, but those gains couldn't hold, left these candles up here on an island, reversed back down. We've now established this low around 12. If it breaks down below 12, I would be very careful. ALK, now we're moving into the airlines, Alaska Air, another one that moved up, pulled back, and I think we got to watch this pullback here. We want to see this hold around $35. So we did get an opening gap lower in ALK. I think to the upside, 41 and a half you want to watch, downside 35. But this is a stock that I think is just short-term trapped. If you're a believer that this virus is the worst part is behind us and we're going to continue to improve, then airlines are probably going to continue to strengthen. It may be a slower process, but I would expect them to continue to strengthen and look for that breakout above about 41. All right, quick update on the market. We'll wrap this thing up. Currently, we got the Dow up 66, S&P up 9, NASDAQ up 44, and leading on a relative basis, as you can see. VIX down a little bit. I will mention in 2 days, options expire. I always get a little nervous as we head into options expiration Friday and the week after, especially if we have seen some pretty good action to the upside, which we have. I think the S&P over the last month now has been up about 9%. So there's a chance that we get a hit a little bit to the downside as a result of Max Payne, because there's so many in-the-money call options right now. That's kind of where Max Payne comes in. We had a great session last night over at Earnings Beats, and if you want to try our membership, get those chart lists that I talked about, you can download several of them into your account. Even as a trial member, you can do that. And also you can go back and listen to our recordings. Last night we did a Max Payne event. I explained Max Payne. It took a lot of time talking about Max Payne, what it is, why it's important, why as a short-term trader you need to be aware of it. If you go into our webinars page, once you get into Earnings Beats, you'll be able to go, we've got them in chronological order. So the one we did last night should be right there on top. Just click on the recording and check it out. But again, go over to Earnings Beats. If you're not a member at all, just go over and sign up for our free newsletter. That's one way to get into our community. Then you'll know about all the events we have. And then the other, obviously, if you want to join, you can go through this, tells you a little bit about what you'll get. And then you can sign up for a 30-day trial. It's $7, but we'll refund you the $7 within 5 to 10 business days. So literally, you'll get it 30 days for free. You can check it out, download these chart lists. I think you'll find that our service is pretty strong. Anyhow, let's go ahead and wrap up. Appreciate everybody tuning in, and have a great day today. Happy trading, and be back tomorrow over at Stock Charts TV at 9 a.m. Eastern. See you later, everybody. Happy trading.